In March 2026, the streets of Dubai emptied out. The world's busiest international airport ground to a halt. Debris from intercepted drone strikes slammed into luxury skyscrapers, and thousands of expatriates fled the region so quickly they left their pets tied to poles outside deserted terminals. While the physical city locked down, Dubai's logistical and digital infrastructure quietly continued to generate billions of dollars in revenue out of sight. To see how a megacity functions without its people, we are looking past the dramatic news footage. We are going to analyze the raw shipping manifests, military interception reports, and real estate indices from the first quarter of 2026. The escalating Middle East conflict forced the United Arab Emirates into an extreme stress test, revealing a specific kind of economic resilience underneath the city's glossy exterior. To measure the scale of the disruption, we have to look at the Emirates' exact position right before the conflict. In 2025, Dubai welcomed 19.5 million international overnight visitors. The hospitality sector ran at over 80% occupancy year-round. This chart shows the scale of the real estate expansion leading up to the war. Between 2021 and 2025, residential sales transactions shot up 464%, hitting roughly $185 billion in a single year as the population crossed the 4 million mark. That growth relied heavily on a single premise: absolute safety. The UAE positioned itself as an untouched haven where global capital could hide from regional instability. Because the brand relied on unbreakable security, the sudden arrival of combat drones and ballistic missiles directly threatened the city's core economic identity. That threat materialized in late February 2026. Iranian forces launched a massive saturation strike across the Gulf, firing over 2,100 drones, cruise missiles, and ballistic missiles at the UAE in an attempt to overwhelm its defenses. The UAE's defense architecture relies on advanced THAAD and Patriot missile batteries. These surface-to-air systems performed well under pressure, intercepting approximately 94% of the incoming projectiles. But firing thousands of weapons into a densely packed urban area guarantees impacts, even with a high success rate. Falling debris and shrapnel struck high-value residential and financial districts, including towers in the Dubai Marina. The most severe economic blow was logistical. The UAE's General Civil Aviation Authority was forced to partially close the national airspace, paralyzing operations at Dubai International Airport. Emirates Airline completely suspended its hub operations. Within days, over 100,000 travelers, including thousands of British tourists, were stranded across the region as global flight cancellations rapidly accumulated. Shutting down the world's busiest international airport severed the city's physical connection to the rest of the globe. It trapped residents in a combat zone and froze the hospitality and retail markets that require constant foot traffic. This chart shows the specific vulnerability of the UAE's population structure. Out of 11.57 million people, 88.5% of the residents are expatriates, including nearly 4.4 million Indian nationals, while Emirati citizens make up just 11.5%. This dynamic creates a conditional social contract. The vast majority of the people living in Dubai are temporary workers and international investors who reside there strictly for economic opportunity and personal safety. When that safety vanished, the migration trends reversed. Wealthy individuals and highly skilled professionals who had the means to leave did so immediately, draining the city of its high-end consumer base. A luxury service economy requires people to dine in restaurants, buy real estate, and shop in malls. When those primary consumers can pack up and fly out at the first sign of danger, the physical economy stops. Yet, while the restaurants and hotels emptied out, the city's invisible logistical and supply chain economy proved remarkably durable against kinetic strikes. This dashboard tracks the financials for DP World, the Dubai-headquartered global logistics giant. Right up to the crisis, they posted a record $24.4 billion in revenue, and Dubai's core systems have shifted into a digital-first mode, prioritizing the automated networks of supply chains over physical foot traffic. With expatriates fleeing and the aviation hub paralyzed, observers expected a property collapse similar to the 2008 financial crisis. But the $680 billion real estate market is reacting differently this time. Unlike the speculative bubble of the past, the current market is built on less leveraged debt and disciplined supply releases from developers. A growing base of long-term visa holders now provides a foundation of end-user demand that didn't exist in previous cycles. The 2026 conflict forced a transition from a fragile luxury destination to a battle-tested operational hub. Despite the kinetic strikes, the city demonstrated it could sustain its essential functions through a period of extreme regional stress. It leaves us asking, is the era of the expat megacity drawing to a close? Or will surviving this stress test ultimately make Dubai a more attractive haven for global capital? Let us know what you think in the comments, and subscribe to Future Focus for more deep dives into the forces shaping our world.